So in this section, I'm going to talk about pretty much what's going on in the economy today. There's many blogs and stuff you'll hear and read where people have been painting this picture of collapse now for going on about 6 years now. You'll look at a lot of websites, and you'll even see some popular people on Twitter saying everything's going to collapse. So I'm here to give you the real deal information of what is actually going on. Okay, the information you're going to get here is not opinion. This is information from the Department of Treasury, the Bureau of Fiscal Reserve, the Board of Governors of the Federal Reserve, the Department of Commerce, which has the Bureau of Economic Analysis, the Federal Housing Finance Agency. You're going to see charts here that show facts, because there's too much opinion out there and people are investing on totally wrong information. There's a lot of individuals also on YouTube who they just want clicks. And the way to get clicks is to say outlandish information. So when people hear this outlandish information, they love it. They eat it up, and they get attracted to this maybe individual's videos and analysis. But what I've noticed is that their analysis never pans out. While most have been calling for collapse since 2008, those who have followed me know that I have pretty much kept people invested in stocks pretty much the whole time. Talking about individual stocks, even index funds, I continually say never short the market. So you could take whosever opinion you want. But at the end of the day, these people, all these blogs and these conspiracy blogs, have been totally wrong. Okay. So now we'll start going over a few charts, and I'll talk about various aspects of the economy. And we'll start with interest rates, because this is a big thing on people's mind. The mantra is interest rates are going to skyrocket and the market's going to collapse, housing going to collapse. Well, I'm here to tell you that this is not going to happen. Interest rates are a demand for credit. An interest rate will only rise when that demand for credit rises. So if the demand for credit never rises, the interest rate's never going to rise. Hence, people are never going to have to worry about a high interest rate really when buying a house, because the demand is just not going to be there. So the chart you're looking at right now is the 3-month T-bill. This is the yield. Okay, and you could see pretty much from the Great Depression in the early 1930s and 40s, it's done the same thing as today. We've had this sort of credit deflation, asset bubble deflation, and yields stayed low for decades in the 1930s and 40s. Yields have only been low today since pretty much 2008. So while everyone says, oh my God, yields have to rise, interest rates have to rise, look at the 3-month T-bill yield. It could stay low for another 15 to 20 years. Now, if you ever want to know where the federal funds rate is going to go, that's the rate that everyone watches on TV that comes out at pretty much 2 o'clock. And everyone says, oh, what's the Fed going to do? Is the Fed going to raise lower rates? Everyone's trying to figure out what the Federal Reserve is going to do. Well, I'm here to tell you, if you want to know where that yield is going, just follow the 3-month T-bill yield. The Federal Reserve follows the 3-month T-bill yield. This is how they raise and lower rates. So if you see the yield on a 3-month T-bill starting to go up, the Fed's probably going to raise rates. If it stays flatlined, the Fed is not going to raise rates. And that's all they do. And Greenspan even said, when they interviewed him, they said to Alan Greenspan, why did you keep rates so low during the housing bubble? And Greenspan replied, he said, I did not keep them low. The market kept them low. So understand that the Federal Reserve, they're not really controlling interest rates. The market does. So the 3-month T-bill yield, this is what you want to look for when you see rising interest rates. And as of now, there's no indication that interest rates, the Fed funds rate, is going to be rising anytime soon. The Fed funds rate is not the 10-year Treasury with pretty much what housing interest rates are tied to. The Fed funds rate is more like car loans and personal consumer credit and stuff like that. But they kind of follow each other in tandem. So, when you see the 3-month T-bill yield go up, that might even show you that the economy is getting stronger. It doesn't always mean weakness. Now, just because interest rates go up too doesn't mean that the market goes down. This is actually quite false too. If you look at the great boom during the 1950s and 60s, interest rates were actually rising during this period of prosperity. Same thing with between, I think it was 2004 to 2008. The Fed funds was continually rising. So this whole notion that interest rates going up is bad for stocks is just total nonsense. It's nonsense. Get it out of your head. If you listen to these people on CNBC, they do not know what they're talking about. They never look at market history. That's one thing they hate looking at is market history. They look at the past 10, 15 years of data and they'll give you an inference off of that data. But it's ridiculous. The next so-called thing you will hear is, oh my God, the dollar's going to hell in a handbasket because nobody's buying our bonds anymore. They're dumping our bonds. Gold is going to skyrocket. Not true. Let's look at this next chart. The reason why. This is federal debt held by foreign and international investors. Now, do you see this thing collapsing? No. It's actually hitting all-time highs. Okay? So this just puts the whole conspiracy movement to rest. I mean, foreigners are buying our bonds. You look at the world around us. The world around us is very unstable, financial-wise. I'm not talking about militarily-wise and political-wise, although that, obviously, they go hand in hand together. But financial-wise, the United States is still one of the best places to invest. It has the most liquid markets and the most stable currency. Our central bank has pretty much the most unlimited reserves to stabilize the currency, whereas other countries, you look at, say, Argentina, they only have a limited number of reserves, pretty much only in the billions, where if they need to prop up their currency, so they pretty much can't. So look at this chart and you see that federal debt held by foreign investors is rising. And this is from the U.S. Department of the Treasury, Bureau of Fiscal Reserve. This is not some made-up chart or some what I think is going to happen. This is just fact. This is what I like to deal in. Fact. That's it. Now, you can maybe make a case in 1999 when it started to go down. Who knows? That could have been Y2K fears. But the bottom line, even during our crisis, it went up. The foreign reserves held by international investors went up. Why? Because the dollar, that's why you saw the dollar get so strong and interest rates collapsed. People bought all of our debt. It wasn't the opposite what people are trying to tell you, where they were dumping our debt and Russia's buying gold. It's nonsense. It's not. The opposite has been happening. The only reason you get people saying that Russia's buying gold and the dollar is going to collapse is because Russia today has had a big influence on the internet community since 2008. They're Russian propaganda. ZeroHedge.com and Russia Today, it's just propaganda. And unless you've figured it out by now, they've been wrong about everything. They try to keep bringing out people that talk about collapse. They keep rolling out various people. They love it. They can't get enough of it. And they have a big YouTube and internet presence because a lot of people, they can't look at these charts for themselves. And people are making investment decisions off of that very dangerous opinions of those organizations. So again, be very careful what you read and listen to. Okay? Now, a lot of people also ask, is the stock market going to collapse 90% like it did in the Great Depression? Again, no. During the Great Depression, we did not have FDIC insurance. What happened was banks went under and people lost everything. And it was just a domino effect with the banking system where one bank went down after another. People were leveraged on stocks 9-1. You could buy in a margin. So if you had $10,000, you could buy $90,000 in stock pretty much. And when the markets went down 10 or 20%, that's it. People lost everything. And there was a huge deflationary bust. No FDIC insurance. There you go. 90% drop. That's what happens. Is it going to happen today? No. When that happened during the Great Depression, industrial production collapsed. This is a chart of industrial production, and although it doesn't show the 1920s and 30s, it collapsed during the Great Depression. Now, is industrial production going to collapse again? No. Actually, it's kind of back down to its longer-term trend line since the 1970s. So if you see industrial production totally collapse, then maybe you could start thinking about that happening. But I just don't think that's going to happen. Again, nothing I say is set in stone, but this is what I look at. I look at facts when I try to make decisions as to what will take place in the economy and the stock market. So growth could, of course, continue. Another thing we could look at is real GDP growth. This is from the U.S. Department of Commerce. Okay, now real GDP takes into account inflation, so you get a more accurate picture of that growth. And as you can see, real GDP growth is consistently in an uptrend. Sure, there are little bouts, recessions here and there, where real GDP growth doesn't really do much. It goes down, it corrects back up. But pretty much you could rest assured that real GDP growth is going to continue to grow. And in 20 or 30 years from now, it's going to be a lot higher. Another chart we could look at is the personal savings rate. The personal savings rate is actually stabilizing and kind of making an uptrend. You can make the case for that. You could make the case for that during the housing boom, maybe starting in the mid-1990s to 2005. The savings rate really collapsed. Why? Because most people used their homes as an ATM. Okay? So what happened is they were extracting all the equity out of their houses. They were using it to, say, go out to dinner, buy clothes. It was kind of a boom. You saw the boom in the stock market. And now people are repairing their balance sheets. They realize that housing is not going up ever again like it used to. It's going to go to a slow, steady growth rate. They're not going to be able to use their homes as ATMs. And this is getting reflected in the sentiment. You're seeing the personal savings rate rise. Now there'll be spikes. It's a little volatile. Don't take this information too literal. Don't worry about what happens on a year-to-year basis. Just understand that since pretty much housing topped out many years ago, the personal savings rate has been steadily rising. As slow as that may be, there'll be spikes, there'll be collapses, but I believe this uptrend is going to continue. And it's going to continue more in line with what it was like maybe in the late 1980s, that average area where maybe people are saving between 5 and 10%. That's healthy. You want that in this economy because that's going to set the stage for solid future stable growth. Okay, so I mean all these metrics, what we're looking at right now, does this really spell out collapse to you? I mean, if you want to take that view that we're going to collapse and everything's, going to hell in a handbasket, you could take that view. That's fine. But before you take that view, I want everyone to just look at these charts. Watch this video again. Use facts. Do not use opinions. When you look at facts, it's easier to understand things. These are the real economic statistics. Now, are some economic statistics a lie? Yeah, I mean, certain things like inflation rate is definitely understated in certain areas. You can make the case for a lot of things like that. But most of this stuff is pretty legit. It's not lies. The 3-month T-bill yield is not a lie. Federal debt held by foreign investors, it's not a lie. You can't really manipulate that. In industrial production, you're not manipulating that. You're looking at industrial companies, what their sales are, and making everything into an index, and you're not, what I mean? You're not really, you can't manipulate this data that much. Maybe real GDP growth could be manipulated a little, but there's not much to manipulate here. So I want everyone to understand that, the case for the market collapsing, it's really not there. And I think we're going to have sustained growth over the long term, and we may even enter a great bull market. There's going to be years where 2-3 years we may have a bear market, but I believe this bull market is in the early stages, and it's going to continue to last. The same thing pretty much happened in the 70s. During the 1970s, people just thought stocks were never going to go anywhere, and then in the early 1980s, they went on one of their biggest bull markets ever. Many people look at metrics and they say, I think it was Warren Buffett's favorite indicator. It's a market cap to GDP ratio, something like that. The problem with a lot of those ratios is that we're in a global economy now. Most of the S&P 500s, over half of their profits of those companies are to different countries. So you can't really use a lot of these metrics anymore to figure out where the market's going to go. You really need to just do a bottom-up approach. And what I mean by bottom-up approach, there's two different approaches. There's a top-down economic approach where you look at country first, and then you look at the overall economics. And then a bottom-up approach is just looking at individual companies. And that's what some of the most successful investors do. That's what I do. I mean, most of this economic analysis I'm showing you right now, to be honest with you, I don't really look at it. I look at it just to see, give me a gauge of what's going on in the economy. And I see things look pretty good. But I don't really care what this stuff does. If I were to tell you what the 3-month T-bill is going to do in 3 years, you're not going to make money off it because you don't know how the market's going to react. Is it priced in? Is it not priced in? You'll never be able to make money. So the bottom line is that all these things, use a bottom-up approach. That's what I use. Or shall I say, do what makes you feel more comfortable. But I use the bottom-up approach where I look at individual companies. In the next section, we're going to go over all these individual companies that I like. These are companies like I talked about earlier when we were, doing the balance sheet section. Companies that are going to continue to deliver excellent returns for long-term shareholders. So the economy's not in this crazy rut. Don't listen to all these people. They don't know what they're talking about. Here's another chart. This is the house price index for the United States. Again, you could see this is kind of going along its long-term trend line. That whole bubble deflated, and now we're back to long-term sustainable growth. This is extremely healthy. But most people might say, housing's still going to collapse. Listen, housing's not going to collapse. It pretty much went down like 80% in Miami and Las Vegas, and all over the country it went down. Give me a break. We're not going down more, okay? There'll be pockets here and there of weakness. Of course, that's normal, and that's healthy. But we're just going to be on the long-term classic sustained growth rate with housing, which is not really much. You don't buy a house for an investment. You buy a house just to live in, and that's it. But looking at this chart shows you that, we're back into equilibrium with the historic growth rate, and this is healthy for the stock market and very healthy for personal savers, individual investors, and just families. We could start getting the family growth again. And, these millennials are having such a huge tough time with the job market. But as all this stuff works out in the future, all these millennials are going to come into the market too, and it's going to be your next growth phase. So again, all these metrics, you don't need to use these to make great investments. You really don't. I'm going to show you later on, all the stocks I like, and you're going to get a much better analysis of, okay, it's better to do a bottom-up approach and look at individual companies, but this stuff is great just to kind of know what's going on so you don't get swayed by, losers who don't really know what they're talking about. That's why I look at this stuff. I don't want to be swayed by the zero hedges and the Russia Today. Now, I don't want to be persuaded by CNBC talking gloom. And the way that I make sure I don't get persuaded is I look at all this economic data. And then once I know the data, people could say whatever they want. I don't really care. I do my own analysis. And this helps me hold on to my investments for the long term. I don't get scared out of stuff. It's ridiculous. Especially like when I look at this house price index for the United States. I don't need to worry about, oh my God, I got to sell my house. No, if anything, you should be buying a house right now. This is probably one of the greatest times to buy a house in history. Not only has the house price index went down to its trend line, but interest rates are at all-time lows. So, this is one of the best times to buy a house price. And I said that in a newsletter a couple of years ago. And since then, housing has went up those past 2 years. Like I said, real estate's very local, but I'm just talking in general terms. Commodities are not a good long-term investment. If you trade in and out and you catch a commodity bull market run, then maybe okay. But first of all, there's really no way to play commodities. The ETFs that track commodities are garbage. They have these fees because they basically follow futures contracts. So, a futures contract doesn't come with no cost. You have to keep rolling over the contract. And there's a cost to that as the contract expires and you roll it over. So that's why you see these ETFs, they never track the commodity. It's not that the ETF is not tracking it correctly, it's that it's accounting for that roll and you're losing money on that roll. So the only way to really get direct exposure to commodities is if you own the actual commodity. And nobody's going to sit there and take delivery of bushels of wheat or barrels of oil. About the only commodity that you could own outright are precious metals. But as you'll see later on, I'll show you, even precious metals are terrible long-term investments. They're terrible. Commodities just, you hear a lot of people talk about commodities when the dollar gets weak and we're in a commodity bull market. And that's when you hear everybody talk the most about commodities. But the bottom line is that most people really don't know a damn thing about commodities. They really don't. They talk about owning commodities, but little do they know is that the best way, if you do want to own commodities, is through commodity producing companies or commodity stocks. Companies that have the infrastructure that say, maybe mine for gold, which, gold mining is one of the worst sectors in the world. I would stay away from it. But, certain oil companies, they have the infrastructure, maybe drillers, maybe companies that sell the drilling equipment, maybe, companies like ExxonMobil or Chevron, different midstream companies. They have energy infrastructure and they're in the industry. So that's the best way to play commodities, by the individual companies. But commodities themselves are not good long-term investments. I mean, just look at any company. Say you look at ExxonMobil over its 30-year history of making, a boatload of money for shareholders, and then look at a chart of oil. And here's a chart of oil, and you'll see it really has done hardly anything since the early 1980s. Even with this huge oil bull market since the early 2000s, really, here we are, almost 2015, and oil is really only 130% above where it was in the early 1980s. That comes out to like not even a 1 or 2% return per year. It's less than the inflation rate. So most of these commodities, especially oil, as there are discoveries and as the technology to drill and to hunt for oil gets better, it's not going to keep going up. There's going to be a point in time where actually we might even transition from an oil economy and not even use it anymore. So it doesn't matter if the world is even running out of oil. By the time the world does run out of oil, we're probably not really going to be using it that much anymore. So like I said, owning these commodities, it's not a good way. And you could look at all different commodities. I could show you charts of sugar, wheat, silver, pretty much any commodity out there, and you'll see that over the past 30 or 40 years, I mean, really, it doesn't do much. It has these quick spikes, and even the spikes pretty much go up, but then they kind of crash, but then they'll go back up and stabilize. So as an investor, the psychological ways of holding these commodities is just no good. I mean, you're not really going to make money. They're too volatile, and there's really no way to get direct exposure to these commodities, except if we're talking about gold. So gold, again, here, you could turn around and say own the gold mining stocks, but here's a chart of the XAU gold mining index. This is the index of all gold mining stocks. And now, since the early 1980s, it's done nothing. Pretty much since the 1970s, it's pretty much lower than it was in 1980. So, great companies, like I was talking about General Mills earlier, great companies buy commodities and sell brands, all right? Mining companies just sell commodities. There's no one company that differentiates itself from another, except maybe, they're cutting costs a little more. That's about all a mining company could do, is cut costs better than its competitor. But they're not selling, the gold that say, Randgold Resources sell is not really any different than the gold that, another company sells. It's all gold. It's the same thing. So, you see this whole boom-bust nature with gold mining industry, and just look at this chart. I mean, it just shows you how terrible this industry really is in. I mean, you just stay away from it. There's no need to really invest in a gold mining company. I mean, because this is what you're dealing with. You're dealing with, mine shutdowns, safety regulations. You're dealing with the actual price of the commodity collapsing. then it goes up, and then they have to hire more people, but then they hire too many people, and then there's a bear market in the industry, and they took on too much leverage, and the company collapses. Stay away from these companies. There's really no need to own a gold mining company. There's not. I mean, if you do, maybe you could own a gold mining mutual fund. I like the Tocqueville Gold Fund run by John Hathaway. It's got low fees, and they really, look at the industry, the company balance sheets. They really do pick out the best managed gold mining companies. The Tocqueville Gold Fund is a pretty decent mutual fund, but really most of it, I would really stay away from most companies in the gold mining industry. And you look at, here's a chart of gold over the past, 35 years. And again, it's just really like boom bust. I mean, at the top of a bull market, you'll hear all the praise for gold. And that's what usually happens. It draws people in talking about, the dollar's going to collapse and this and that. And, you can't even use trend lines with gold. I mean, look at this trend line on this chart. I mean, when it collapsed in 2008 and 2009, it never touched its trend line that it formed from like 2000 to 2007. If you drew that trend line, it never touched it. It actually kept going up. So, if you were waiting for it to hit the trend line, you lost out on everything. Then when it went up, it corrected back down to the so-called trend line, but now it's breaking the trend line. I mean, look, like I said earlier, looking at trend lines is complete garbage. It has nothing to do with it. If you want to own some gold for insurance purposes, that's fine. I always talk about that, talking about things like maybe an electronic pulse bomb, or if something happens, with the markets. But gold in general, I mean, you're not going to make long-term returns. It doesn't pay a yield. You can't reinvest dividends because there is no dividend. And again, you got to ask yourself this question: if gold is money, then how could one become rich by just holding money without investing that money and taking risk? You get what I'm saying? So if you just hold gold, and gold doesn't pay an interest rate because gold is money, that's it. How could you get rich without taking risk? If everyone just held money and just saved it every day, and they all of a sudden got rich, I mean, then, the richest people in the world would be the gold holders. But that's just not true. Also, gold's not even monetized. I don't see it becoming remonetized either. So, I mean, nobody's really buying up gold. People are just buying it to see if pretty much a greater fool buys it. The next person buys it off them at a higher price. And when you invest in gold, you're pretty much just going off of the greater fool theory. You don't really know when fear is going to spike and people are going to bid up gold, but you just buy it pretty much hoping for that to happen. And, when I invest, I don't invest on hope. I invest on a real company, cash flows, something that I could value, a business I could value. I could tell when a company becomes a good value based on cash flows and the brand and the sustainability of their business. You can't do that with gold. You can't. It's a crapshoot. You buy gold, it's just a total crapshoot. What's it going to do next year, next week? Anyone that tells you differently just really doesn't know what they're talking about. And this whole thing of like, all right, there's a silver shortage. There's not. The way companies show silver on their books is just the resources that the mineable resources that they know that's there. They know in these mines there's a lot of other big silver veins that they could hit when they drill. The problem is getting to those veins is tough. They can get to it, and they do eventually, but they just report on their reserves what they could get at right away for the next quarter or the next year. And that's why when you see reserves, people think, wow, if they add up all the reserves to all the silver company, they say, wow, there's a silver shortage. Look at all the money sloshing around, and look at how much silver is available for investment. But that's just not true, because these silver companies will keep pumping out silver. They're just not going to show it on their books. They'll show just a couple years reserves, but they may have 30-year reserve, a 30-year mine life, but that will not show up on their books. So that's a whole other story you could get into about the whole silver shortage, which is a complete scam. I mean, the silver shortage scam has really taken a life of its own. It's really sucked in a lot of people. I mean, I do own silver, like I said, just because it's more of like a novelty. And for, like I said, an electronic pulse bomb type thing. It may go up with inflation over the super long term, but don't really invest in this stuff. It's kind of a waste of your time. It doesn't, like I said, and it's kind of risky holding it at your home. There's been a lot of break-ins. Crime could get crazy, and you may not think you'll be the victim of a crime, but that's when a crime happens, when you least expect it. Everyone thinks that nothing's going to happen to them. Everyone thinks that, all right, I'll never get sick, I'll never get cancer, I'll never get robbed, I'll never get into a car accident, I don't need insurance. But the bottom line is, if you have all this gold and silver sitting in your house, that's very dangerous. I mean, why would you do that? Now you could be putting, the life of you or your family members at risk. Say someone knows your gold, knows you have gold. A lot of people that have gold tend to talk about it. They tend to tell their friends and family, yeah, I own gold, I'm cool. Little by little, word could get out that you own gold, and you could have a home invasion. People think you're on vacation. You put on Facebook that you're going on vacation, and then someone thinks you're away, and they go to rob your house, but you're really home, and then just be careful with this stuff. I mean, nothing really good comes from it, and you'll make much more money investing in just regular companies that pay a dividend that I'll talk about later on. You don't need this stuff. And people talk about this whole manipulation game. There's no manipulation. If gold was manipulated, then why is oil down too? Why is sugar down? Why is copper down? And you just look at oil and copper. I mean, if there's any, you don't need any other validation that, commodities aren't manipulated. I mean, those commodities are down too. I mean, oil is really not much higher than it was from the early 1980s. Pretty much the same thing as what gold is doing. And oil is traded on the world markets. I mean, just don't fall into this nonsense about buying this stuff. That's why I wanted to add this section to the newsletter, because, companies, especially buying great companies on corrections, will make you the real money over the long term. This stuff, there's been so much nonsense on blogs, YouTube, all these various websites, and, I don't want to see people continue to get hurt. Gold may just as well go up again. That's fine. But it's just this crazy ride of boom bust. I mean, why subject yourself to that? It's just silly, and there's just really no need to do that. So when most people realize that they can't really make money in the stock market, they usually end up jumping to other avenues to gamble their money. So, maybe making money in the stock market's too slow, or it's just not fun enough. There's not much action there. And that's when you'll see people start drifting towards commodities, getting a little more action. Maybe they go to options. Then they kind of lose at that game. And then they find, the wonderful world of currencies with the huge amount of leverage, the stories they read that, you could get really wealthy with currencies. You hear the story always thrown out there about, George Soros and how he broke the British pound and made, billions of dollars in a day. All these romantic stories about currencies, but the cold hard truth is that a guy like George Soros has inside information. In his own book, in his own articles, he says he has insiders inside the central banks. He says he has friends at most all the central banks. So where do you think he gets his information? The central banks he talks to, he gets dinner with these people, and they pretty much tell him an inside account of what's going on. Why else would he leverage his, almost his whole net worth on the devaluation of the British pound? I mean, are you out of your mind? Because the guy had inside information. I mean, that's why. Yet, average Joe Blow is out there, trying to be a currency trader because he's reading the Wall Street Journal. I mean, it's just silly. It's totally silly. So, currencies, stay away from. This is another avenue, I'll tell you, to stay away from. It's nonsense. I mean, I've seen so many people lose so much money with currencies. It's just laughable right now. They have like the Japanese housewives trading currencies. It's so funny. But here's the deal with currencies, okay? Currencies are managed by governments, okay? They're not managed by, it's not really a free market. Central banks pretty much prop up their currencies. They defend their currencies. There's a lot of currency pegs going on. It's political policy, these pegs. So you're basically trading up against powerful governments and extremely powerful sovereign wealth funds who, might be doing the trading for these governments. So there's no way of telling where a currency is going to go. They're managed. No chart is going to ever work on a currency. No trend line, nothing. Look, this first chart is the China-U.S. foreign exchange rate. China has a peg against the U.S. dollar. So, you could see how, and I'm not saying that all these markets are liquid. You're going to start trading, China versus, the yuan and stuff like that, because you're not. But you'll see that it affects economies, and trading off it is totally useless. I mean, it's whatever China's policy is. I mean, you'll see in the 80s and 90s, China had a policy of weakening the yuan. I mean, this was the whole era of made in China, okay? And now a stronger yuan is kind of making the era of, made in the USA. And what happens is there's a direct correlation with what the governments want for their country and what they do with their currency. So if you think you're going to get in front of that trade, you're just asking for trouble. Okay, you're totally asking for trouble. I mean, there's just no rhyme or reason. I could talk about these charts all day long and put charts up here, but it's useless because it's totally useless looking at a chart. This next one is of the euro. And here I made a chart of the euro. I've actually, you might have seen this chart before. I've posted it actually on a previous newsletter and on the Twitter account. But it basically goes to show you that during the whole euro crisis from 2008, and I have it going into 2013, the euro was just meandering in a volatile manner. And people might have thought as the ECB was cutting interest rates that the euro was going to tank. And actually the opposite happened. If you see as the European Central Bank was cutting interest rates, the euro was actually going up. Okay, and there's just so many different things that happened. Like, Ireland sought financial support, and you would have started thinking that the eurozone's going to fall apart. The ECB announces additional U.S. dollar liquidity operations. So all this stuff, and then what happened? It's pretty much the euro index is in pretty much the same area as it was before the whole crisis started. So anyone who traded this is a fool, because at the end of the day, they really haven't got anywhere. I mean, again, owning a currency is like owning, not owning gold. I'm not going to say that because gold is money, so gold technically can go up over the long term with inflation. Floating currencies, they're called floating for a reason because they float to the bottom eventually. So, I mean, you're not going to time and trade the wiggles of these markets. It's impossible to know what was going on. Even if you knew the ECB was going to cut rates, look what happened. You might have shorted the euro, but you would have lost. They actually what happened is it was buy the rumor, sell the news. They actually shorted. Someone had inside information in this chart. You'll see in the middle of 2008, currency traders had inside information of what the ECB was going to do, and then look what happened. They sold off the euro, they shorted the euro, and then what happened? Then the ECB cut rates, and then what happened? Nothing happened. They just covered their shorts. So trying to play these wiggles is useless. Here is a chart of the Japanese yen. Again, really no rhyme or reason for why things happened. Since this chart was posted, the yen has pretty much collapsed. I think the yen is under par with the dollar now. I mean, who would have really known? I mean, at the time, you would have thought the yen was going to be the next great currency. And then that thing just collapsed. This Shinzo Abe, they did Abenomics where they just started printing money. I mean, nobody really would have known this stuff is happening. Again, silly, very silly. This is a chart of the U.S. dollar index. Remember, and I always talk about this chart, and I like to bring it up. The U.S. dollar index is not U.S. purchasing power, okay? Purchasing power is much different. The dollar index is just an index. It's the dollar against other falling currencies. So it's the dollar against the euro, the dollar against the Swiss franc, the dollar against the Japanese yen. There's 4 or 5 major currencies, and what happens is that they all pretty much fall together. So if they're all falling together, they're all going to be in the same exact place 20 or 30 years later on the index, not purchasing power. So if you look at the U.S. dollar index since 1990, all the printing that's going on, the index is at the same place today as it was in 1990. So you might say, well, how can that be? They printed all this money. Well, once again, this chart is not measuring purchasing power. So when you hear people say that, the dollar is doing this, the dollar is doing that, buy this, buy that, it's useless because the dollar index is it's an illusion, okay? Basically the dollar index is in the same place since the early 1970s. Yet, how many times in value has gold risen since then? Since the early 70s, gold pretty much went from 35 an ounce to, where it is today, above 1,200. So this isn't purchasing power. This is just a dollar index. A totally useless chart. No need to trade off this chart. You can't. It's useless. Like I said, when you trade currencies, you don't just trade the U.S. dollar. The U.S. dollar you trade currency pairs. The U.S. dollar has to be paired up against something else. So if anyone who knows about trading currencies, you'll know that you have to trade. All right, I'm going to trade the U.S. dollar, Japanese yen currency pair, the U.S. dollar Brazilian real currency pair. I mean, you're trading pairs, so you're just trading against the other currency's government. And if you think you're going to outwit the government, know what they're going to do, you're not. They don't even know what they're going to do half the time. It's a big scam. I mean, so be careful. I mean, you'll see a lot of commercials on TV like CNBC for currency trading, and brokers love it because they generate so much commissions from currency traders. They love it. There's a lot of leverage involved. There's a lot of panic involved. When people leveraged up, they're more apt to watch their investments much closely, and they're very apt to selling quickly. So, if you're in a big leveraged currency move, what are you going to do when the trader moves against you? You're going to quickly sell out of that position. You don't want to really take the pain. So what happens is you get all these commercials on CNBC about currency traders, and they're marketing it to you. I mean, really, unless you're a central banker, what do you know about currencies? I mean, even the greatest investors in the world, Warren Buffett, has even said, I have no clue where currencies are going. I would never trade a currency. Peter Lynch, great fund managers, they say the same thing. They don't know where currency's going. Who cares? They don't really care. They're just worried if the limited brands is going to sell more Victoria's Secret bras. I mean, in the end, that's really all that matters is the company you own. Are they selling more product? I mean, the currency could affect things short term, but in the long term, things pretty much all equal out. So again, the whole currency trading game, stay away from it. If there's anything, if this newsletter does anything helping you with, I hope it helps you with not making mistakes and not getting involved in the whole commodity game, the currency trading game, even the option trading game. Don't get involved in it. And if this newsletter just helps you with that aspect and it keeps you from these markets, then I think the newsletter actually did its job. And, that's why I like to show everybody the risks and the hidden risks in all these markets, because they have, these big banks have, $1 billion pretty much marketing budgets, and they have like unlimited marketing budgets, and they just market all this get-rich-quick nonsense to everybody. If you ever look at all these commercials, they show people on a beach, blue water, the guy has silver hair, the woman, they're just in great health, they're like great-looking people. You never see 70-year-old people who look like that, but they're like tip-top shape, they look so happy, yet this guy's like a currency trader by day, then he goes out in the afternoon and drives his yacht with his golden retriever on board. I mean, it's silly. It's so silly and laughable, but yet people still fall into it. They think they're going to get rich off it. So, again, currencies, stay far, far away.